Hello, my name is Yunshil Cha in Washington State University. Today I'm going to present a paper, Do Firms Understate Stock Option-Based Compensation Expense Disclosed under SFAS 123. It's written by David Aboody, Mary Beth, and Ron Kasznik in 2006, and this is published in Review of Accounting Studies. Firms can choose either to disclose or to recognize employee stock option compensation expense. We call that expense SFAS 123 expense. This paper is looking at disclosure of the expense rather than the recognition. So research questions are, do firms understate disclosed SFAS 123 expense by understating option value estimate? If so, which of the inputs are associated with firm's understatement of option value estimates? The managers use these 4 inputs when they calculate option value estimates. So this paper is looking at, is expected option life associated with firm's understatement of option value estimates, or is it expected stock price volatility, or is it expected dividend yields, or is the risk-free interest rate associated with firm's understatement of option value estimates? Let's look at the research design. Okay, this is the model that we tested for our research question. So dependent variable is option value, OPT val, is the estimated value of each option granted by the firm as disclosed under SFAS 123. So this is actual data firms disclosed. On the right side, option value calculated is an option value estimate we calculate using the Black-Scholes option pricing model. And 3 independent variables are complex, RESCOM, and golf. Complex is a magnitude of stock option compensation expense. Firms attempt to minimize investors' perception of its magnitude, so we predict negative relationship between complex and option value. RESCOM is a proxy for excessive executive pay, so we also expect negative relationship there. And golf is a proxy for corporate governance based on IRRC score, and we also predict negative relationship between golf and option value. Option value is based on firms' expectations of option life, future stock price volatility, future dividend yields, and the risk-free interest rate. It reflects managers' incentives and opportunity to understate SFAS 123 expense. But option value that we calculated is not affected by firms' discretion. So by putting option value calculated on the right side, we control for everything else but managers' incentives. And that way we can examine managers' incentives and observe the pure relationship between option value and each independent variable. So relationship between option value and complex, and option value and RESCOM, and option value and golf. Okay, let's look at the result. Okay, this is table 3. If you look at these 3 coefficients, they are negative. So disclosed option estimates are negatively associated with complex, RESCOM, and golf. This indicates that firms are more likely to understate SFAS 123 expense when the stock option compensation expense is large in magnitude, and when excessive executive pay is higher, and when corporate governance is weaker. So this is the model to test which of the inputs are associated with firm's understatement of option value estimates. We isolate one input assumption at a time. I only listed one here, but we have 4 models for each input assumption. We have 4 inputs, so we have 4 models. So we calculate option value calculated life on the right side, right here, using expected stock price volatility, expected dividend yield, and risk-free interest rate. Instead of using expected option life, we use predicted life. In the same manner, we calculate option value calculated volatility using expected option life, expected dividend yield, and risk-free interest rate. Instead of using expected stock price volatility, we use historical stock price volatility. So the difference between option value and option value calculated volatility reflects the manager's discretion on particular input assumption, in this case stock price volatility. So with our model, we isolate each input assumption, and here is the result. Let's look at panel A in table 4. The 3 coefficients in panel A are all negative. Right here. This indicates that managers use option life to understate option value estimates. And if you look at panel B, we see 2 negative signs. And if you look at panel C, the coefficients are all negative. 3 coefficients on complex, ResCamp, and Golf are all negative. This means that firms use dividend yield to understate option value estimates. If you look at panel D, they are not negatively associated with option value estimates, so we find no evidence that firms use the risk-free interest rate assumption to understate option value estimates. We have 3 major contributions. Unlike prior literature that focuses on recognized option, this study observes disclosed option estimates and investigates managers' incentives and opportunity to understate SFAS 123 expense. So it more focuses on disclosed option estimates rather than recognized expense. Also, this study examines managers' incentives to understate expenses other than earnings management. SFAS 123 disclosure has a unique setting. Unlike other accruals, SFAS 123 expense will not cause subsequent earnings reversal. So managers do not understate the expense to manipulate earnings. This study examines managers' incentive to understate expenses other than earnings management. Finally, isolating each input assumption and observing the impact on managers' incentives provides a better way of understanding SFAS 123 expense. Thank you.